Well, welcome everybody. Today, we're going to be talking about what happened in the real estate market in the Santa Clara County area in July of 2020. My name, if you don't know that by now, is Michael Devlin with the Michael Devlin Group. And this is going to look at a snapshot of where we are, where we've been, and eventually we're going to talk about where we're heading, assuming, we know that. So start with sales. If we take a look at July of 2020 and we compare it to July of 2019, you can see that sales are actually up. They're up 7% for single family homes, 11% for condominiums, and 5% for townhomes. That's just for the month of July. Now, if we take a look at the trend of year to date, skipping August that is, and we look at where the sales have been up and where have they been down, notice the hit that happened in April and May, where it was starting to go down in March, but April and May, the sales plummeted in Santa Clara County. But then take a look at what happened in July. July, the sales in Santa Clara County are actually on the increase. They're going in the other direction. So sales are down overall, but as you can see, they're going up. If we graph it a little more graphically, you can see where we started out in January with more sales than we had in 2019. That continued into February. March it went down, April went down, May it went down. But notice with the V, almost a V, it's sort of a shallow V, as the number of sales are going up. If we're looking at where are the sales in Santa Clara County, one thing that really stands out is the Morgan Hill, Gilroy, San Martin area. That area of San Jose, that marketing area, had the most sales, not only in 2020, but also back in 2019. And notice that there was a 37% increase in sales in that area year over year for the month of July. CalBRE is up 22%, Sunnyvale is up 45%, Willow Glen, a perennial favorite, is up 49% year over year. And in the upper end ranges, we still have Los Gatos and Monte Sereno, not talking about as many sales, but it's up 51%, and even Evergreen is up 23%. So sales are down in some areas, but then they're up again in other areas, and it has to do with the desirability of the area, price, and a bunch of other things. There's also a difference depending upon what price range we're looking at. This is the area where we have the most increases in sales, the 1.1 all the way up to the 1.6. I think it's interesting that 1.4 to 1.6 million, that's what those numbers mean, is up 18%. And if we look at the high end market, where we're looking at 1.8 and above, up to infinity and beyond, you can see sales are up significantly in the higher price ranges year over year. Contingent and pending gives us an idea of what's happening next. And you'll notice in March, April, and May, the number of contracts written obviously dropped significantly. 57% drop in pending and contingent listings in April, but then it started to pick up again, as you can see in June, and 18% increase in July. If we were to graph that, you will see that the blue representing 2019, starting in March, there were more pending sales. That was the beginning of the decline. April, there was a lot less pending sales, but then look at what's happening in May, as it's starting to pick up. June and July, the number of properties that went under contract in Santa Clara County is actually up year over year. Sales are increasing. If we look at the price, you can see prices are up. Single family homes year over year, this is for July 2020 compared to July 2019, a 7% increase, 16% for townhomes, only 3% for condominiums. So sales are up and prices are up. That sounds good. The list to price ratio asks the question, if the seller was asking for $1 million, did they get $1 million? Did they get more than $1 million? Did they get less than $1 million? And the answer is they got about what they were asking for. Now, averages can be, I don't know, not necessarily accurate. in the sense that if I were in a room and it was either really, really hot sometimes or really, really cold at other times, if I average the temperature, it might be comfortable, but it isn't always that comfortable. And one of the things I know from looking at the details is that you're going to find people that are getting 5, 10, 15% more than what they were asking, and others getting 5, 10, and 15% less, and it's, you know, sort of a wash. The dollars per square foot ratio gives us a little different perspective than median price, because the median price is the middle price. It means that half of the sales were more and half of the sales were less. That doesn't, if that's going up or down, it doesn't necessarily mean that a particular house is growing or going down in value. It simply means that the median mark is moving up and down. Dollars per square foot gives us a little bit more of a control. Are we talking about the same kind of house, right? Based upon its square footage. And you can see, even looking at that, prices are up for single family homes and townhomes, down a little bit for condominiums when you look at it by the square foot. New listings. This is an important statistic. We need more listings. So in July of 2020 compared to July of 2019, the number of new listings went up 8% for single family homes, 7% for condos, and 17% for townhomes. Now, if we look at where are those listings and at what time point, notice how the market tanked in terms of people putting their homes on the market in March, April, and May. But then in June and July, you can see that it was picking up. If we were to look at this more of a, you know, the timeline graph, looking at it by month, you can see that the blue 2019 is ahead in January. In terms of new listings, it was slightly ahead in February, ahead in March, way ahead in April, even more so in May. So notice then, in a typical normal market, the spring selling season, right? So people are listing their homes in March, April, and May for more closings in June and July and August. But notice, you can see in the blue that in June and July, the number of new listings go down because we were, you know, stifled, for lack of a better word, for a few months. You can see that the new listings, the orange bar, is actually going up to where in July, there were more new listings in Santa Clara County in July of 2020 than there was in July of 2019. More listings, right? And where are these listings? Well, Morgan Hill, Gilroy, Santa Clara, Central San Jose, Sunnyvale are up there with double digits increase. Also, Campbell, Cambrian, and Willow Glen are showing increases in the number of new listings. Los Gatos and Monte Sereno, right? There's 32 more listings that have come on the market in July of 2020 compared to July of 2019. So much for the death of the high-end market. And Santa Teresa has an increase of 13%. But you can see from the ones I didn't highlight that some are actually down. Milpitas is down, South San Jose is down, Almaden Valley is down. They're not all up. And what price range are we talking about? And it's everything really over $1.1 million, right? 1.1. And if you look, where it really starts to pick up steam is the 1.4 to 1.6, 1.6 to 1.8. So that's where the increase in the new listings, those are the price ranges that we're seeing right now. Months of inventory. So in July of 2019, if we stopped listing any homes and we looked at how many sales we had in the past 30 days and then computed if we kept selling at that same rate, how many months of inventory would we have? It was 1.8. In July of 2020, it's 0.9, which means we have less than 1 month of inventory. That's single family homes, a little bit better for townhomes and condominiums, but still you can see the inventory level, the months of inventory we have has gone down. This is an indication as to whether or not we're in a buyer's market or a seller's market. Now, if you research this and Google search and read, you'll see that many of the pundits believe that we're not in a normal market until there's 6 months of inventory. I've been licensed in California for a long time, active in the Bay Area. I don't remember 6 months of inventory, right? Maybe, but a long time ago. So I believe that it's a more realistic metric that we're in a seller's market until we get into 4 months of inventory. Now, if you remember, for single family homes, there's less than 1 month of inventory. Even for condos and townhomes, we're looking at 2 months of inventory. You understand that's still a seller's market. Expired listings. If people have overpriced their listing and it doesn't sell, is that a thing? Not so much for single family homes, right? There were some in July of 2020, but it's not a significant number compared to the number of listings that we have. How long does it take a house to get sold? In 2020, for a single family home, it was a whopping 9 days, right? That means from the day it hit the market, went into the multiple listing service until somebody made an offer and that offer was accepted, it was 9 days, right? Significantly less than last year at 2019. It took forever back in 2019 to sell homes. It took 2 weeks, right, to sell a home. Now, for those of you that were licensed in the last few years or have only been interested in real estate for the last few years, let me just tell you that historically speaking, these are all extremely low numbers. Back in a typical or more normal time in real estate in Silicon Valley, it wasn't unusual to have 45 days or 40 days or something around that number as average median days on market. Homes are selling very quickly if they're priced right, right? And as you can see, it's true for townhomes, condominiums, if they're priced right, and overall, they're not taking very long to sell. And where is that really taking less time to sell? Again, it's the usual suspects, right? 1.1 all the way up to 1.8 is really where the hot spot is. You can see in the 1.1 to 1.2, it's about a week, right? 8 days, 10 days, 9 days. Those are some of the price ranges where homes are selling the quickest, right? And again, as we get into the more expensive ones, it tends to increase the days on market. Active listings. How many active listings did we have in July of 2020 compared to 2019? The answer is not nearly as many. Right, 755 fewer single-family homes were on the market in July of 2020, a 48% decrease in inventory. Right, this is one of the issues is we don't have enough listings. Right now, the number of listings is going up, which is eventually going to help with this. But right now, the active body, the current inventory is much lower. Again, you can see where the number of active listings, if we look at starting in May, it's been up and down, but the number of active listings has been low in 2020 compared to 2019. You can see it went down in May, in June, and July, big time. So if we were to look at, now, this is basically showing you how much inventory we have. How many active listings are there in the multiple listing service in Santa Clara for these different months compared to last year? And you can see how much stronger the blue lines look, right? The inventory last year was much greater than it is in 2020. And even though the number of listings is going up, remember that chart, the number of sales is also going up. And you can see that the difference between May and June and July, and for that matter, April, if you look at those months, how many active listings did we have? It's pretty close to be the same, right? We add more properties to the market. We're putting on more listings, but they're selling, and they're selling very quickly. Look at some of the areas where we have the biggest decrease in the number of active listings. Morgan Hill, Gilroy, and San Martin, right? We had, of course, they're number one in terms of sales. They're also high on the list of new listings, but there are a lot more sales in this area than there are new listings. If you look at Cambrian and Blossom Valley, you can see big decreases in the number of active listings, the inventory, again, because they're getting sold fairly quickly. And the other block down at the bottom, these are all the ones that had a 50% or greater decline in inventory. Right, South San Jose, Alum Rock, Almaden, these areas are where inventory is the tightest. Predictions for 2020 and beyond. First of all, let me just say that anybody who thinks they can accurately predict what the real estate market, the economy, life is going to be like in the future is probably a fool and perhaps even delusional. Having got that out of the way, here are my predictions, right? You know, just saying, that was my disclaimer. Home sales are bouncing back. We've already been seeing this in some of the slides. Even the National Association of Realtors has reported that there was a 26% increase in May, and in June, they went up 21%. New home sales have also been rising. And they were up last year as well. So as you can see from some of those charts, the number of sales are going up. They're going up at the end of summer, even when historically there would have been more in spring. There's going to be more of a rebound in prices, right? They go up and down a little bit. Zillow reported that the statewide, that's for California, median home value had gone up 4%. We expect that this is going to continue, even though in San Francisco right now, there's been an actual decline in prices, and it's projected that they might find a decline going into 2021, but appreciation is expected to pick up. And one of the reasons is that in 2020, there's a lot fewer housing starts, right? That the population is growing, and millennials, which is the largest population, are forming households. They're looking to buy houses, but housing starts are down. There are tenants that may still be paying rent, but that may not last very long. And part of as of July 27th, the multifamily rent payment tracker showed a 93.3%. This is in July of 2020, 93.3% had paid rent. This is an increase compared to last month where it was 94%, and in July of 2019, 95%. So most of the tenants have been paying the rent. However, some of them have been paying the rent because there was unemployment income and other things that they may not have right now. And so the rent moratorium, or the eviction moratorium, the better way to put it, may be over. And unless something happens with people's income soon, they may not be paying rent anymore. Not as many. There's a shift in demand from the urban to suburban markets. This is not a new thing. Right? Back in April, Redfin had noticed that people were searching more outside of urban areas. And this is April of 2020. Redfin said that small towns and rural areas may be set to boom in the wake of the coronavirus outbreak. Home buyer interest in these less populous areas surged in March. It's continuing. In June, the National Association of Realtors economist Lawrence Yun predicted that people will be more conscious about living in high density areas. Yeah, I can see that. So if you don't have to live in a crowded urban area, maybe it would be better not to if you don't want to get the virus. If you want to social distance, it's easier when you have more room between you. In July, the Navy Federal Credit Union economist Robert Frick stated that the numbers also verify that many people are leaving or planning to leave big cities as telecommuting becomes the norm for many businesses. Now, related to that, Google has roughly 200,000 employees. And they've told their employees they can work from home until next summer. Mark Zuckerberg has said that Facebook's goal is that 50% of their workforce will be working from home in the next 10 years, within the next decade. Twitter has already told their workers, stay home, right? Work from home. There is, when the pandemic is over, it is predicted that 1 in 6 of the workers are going to continue working from home. That's according to a study by the Harvard School of Business. And another study from a platform called Upwork believes that 1/5 of the workforce may become permanently work at home employees. So 1/5 to 1/6 is projected of the workforce to work at home. I don't think that's going to be evenly distributed, because the kinds of people that are going to be working from home are oftentimes in the tech industry, or they're in some sort of oftentimes management, white collar kind of positions. Not necessarily all kinds of businesses could you do that. What that, of course, let me just finish this. What that means is that a study that was done in San Francisco asked the workers that if you were allowed to live outside of San Francisco, would you? And over 40% said they would move. So we have people that might be paying extremely high rent or not being able to afford a very large home simply because of how expensive it is to live that close to work. And now they may not need to live that close to work, which means they may be starting to look for places outside of the major metropolitan areas. There's something to think about that. Consumers are buying new homes. I've seen this in my own experience recently. There's a big interest in new home subdivisions. They're not building as many, but there's still a lot of them in the pipeline. And because of the low inventory of existing homes, people are going to go look at new ones. They're cleaner, right? They've never been lived in. If you don't want to live in somebody's used house, right, go get a new one. And it also gives you options. A lot of times the new home subdivisions are not located in the urban areas, right? Because there's no land, there's no place to put them, it's too expensive. So a lot of them are being built outside of the urban areas where there's already a migration towards. Just saying. There will probably be more defaults, notices of default and all of that when people are, so in the CARES Act, there's a moratorium on federally subsidized mortgages that will allow the borrowers to put off payments. If you weren't able to gain employment and you don't have stimulus money and you can't make those payments, at some point it's going to come due, and you're going to have to make up the payments that have been missed in some cases, depending on your lender, and certainly have to start making payments again. So we may be seeing an increase in the number of foreclosures. Now, CoreLogic says that nationwide delinquencies are only about 6.1%. That may not seem high, but it's the highest rate we've had in 4 years. Mortgage Bankers Association says that forbearance, those are the people that are not paying their mortgages, has reached the highest in June to 8.55%, right? Went down to 8.1 in July, but it's still a lot. And some of the lenders, once the forbearance period is over, are not only asking you to start making your mortgage payments again, but they want you to make up the ones you've missed, which may be economically impossible for some people. So one of the differences, does that mean the market's going to crash? Right? Does that mean it's going to, you should be watching that old movie series, I'll skip the movie references. Is it going to be a recession or a depression like we had in 2008 and 2009 or worse? One of the issues back in 2008 and 2009 is that when the economy shifted, very few people had a lot of equity. And that's because we were doing, I'll say that, 100% financing, stated income loans at the peak of the market. And so when the economy switched, then a lot of the people that couldn't make their mortgage payments had no equity, and there was a huge number of foreclosures. Right now, we find that 77% of the people who are past due on their mortgage payments have at least 20% equity in their home, which means that they're in a better position than the sellers were in 2008 and 2009, because they could actually sell their home and pay off their loan without it being something called a short sale or having to go into foreclosure. there's going to be a rise in inventory levels. In July, the California Association of Realtors wrote that housing supply continued to decline significantly across the state, with all areas falling more than 30% in active listings. I've already done that. However, they also polled in July the California Association of Realtors, and they found that many people think it's a good time to sell. One of the other polls I saw said that 47% of the potential home sellers said as soon as we get beyond some of the shelter in place or are able to more effectively show homes and market properties, that they plan on putting their homes on the market. And I think if you look at those numbers for new listings, you can see some of that is already happening. Mortgage rates, 3 to 3.5%. I don't really know, but Fannie Mae and Freddie Mac and the Mortgage Bankers Association, and it sounds like they ought to know, they have their own forecasts, which at least is going to be keeping our mortgage rates between 3% and 3.5%. One of the charts that I showed that just was illustrative of this, if you go back several years and you're looking at affordability in the state of California, prices were lower, but the average mortgage payment was higher than it is today because interest rates were nearly 5%, right? So today, because interest rates are so low, you can buy a bigger house, a more expensive house, and have a lower mortgage payment than you would have had within the last 5 years. So still 3 to 3.5% is a pretty low interest rate. And this is the interest rate chart. Looks like my EKG a little bit, but going up and down over time, and it's going down, right? And it's been going down, and it's historically low, which is one of the reasons there's so much demand for people to buy homes, because interest rates are so low. It's a good time to buy. Well, that's what I look like, and information about me. If listening to this has moved you to buy a house, to sell a house, or to get some help as an investor or as a real estate agent in your career, feel free to reach out to me. I would love to talk to you about that. I'm going to see if you guys have any questions. Let me just, all right.